Welcome to Closing Bell. I'm Mike Santoli in for Scott Wapner here at Post 9 at the New York Stock Exchange. This make or break hour begins with stocks tentatively seeking firmer footing after a jarring week. The major index is struggling to stay in the green most of the day as the breakout in bond yields this week stokes economic concerns. Treasury yields are calmer, though, on the day, and oil prices are quiet. Coming up, Citi out with a new bullish call on Meta. We'll talk to the analyst about why he's optimistic about that name. This brings us to our talk of the tape. Are stocks close to completing a standard seasonal pullback, or is there more payback to come as higher rates test the economy's resilience? Here to discuss all that is Greg Branch, Veritas Financial Group Managing Partner. Greg, it's great to have you here.
Good to be here, Mike.
You have been in the higher for longer on rates camp for a while, also feeling like the stock market wouldn't necessarily be able to handle it all that easily. What has this week told you about the resilience of the market in the face of higher rates, where rates are going, and what it all means?
Right. So one of the issues I've had this year with the bearish posture, Mike, and I didn't maintain that because I'm obstinate. I probably am. But the reason that I've maintained it is that I've been higher than the higher and longer than the longer. And so the market is just starting to catch up with my high, right? A year ago, when I declared my terminal rate at 6%, to put it diplomatically, that was highly scrutinized.
Sure.
But here we are, we're around 50 bips away from that, with the Fed poised to raise more. I know some of us are interpreting that as just one more, but I think that there's several more. So I'm still higher than the high. And in terms of the longer, recall that Fed funds futures projected interest rate cuts in the back of this year. In fact, I think when we look at that 8% growth number for the fourth quarter, that's a remnant of interest rate cuts this year. I don't see how there's any other possible path we could get to an 8% earnings growth in the back quarter of this year without rate cuts. So I don't know if the market's gotten to my longer yet. I don't think there'll be any rate cuts in 2024. Even though the Fed just went, the dot plot suggested only 2 as opposed to the 4 that futures are discounting. I don't know if the longer is long enough. So what does that mean? That meant that my estimates were much lower than consensus estimates, both for this year as well as for next. And when you put even a conservative multiple or a fair multiple on my 225 for next year, that puts me at 3,800. And so while on the high side, the market's catching up, on the longer and on the estimate side, that has yet to happen, and that's why I think I remember.
Well, this year's number is around 225 or 221 by the consensus, right, for this year. Most of the year is done.
Right.
The consensus for next year is like in the 247 range or something like that. So I know you're saying that you think that's way too high.
I can't get there.
But here's the thing. It's not, it's essentially not, it's like 10 or 12% higher than we had in 2022.
Right.
The economy nominally is a whole lot bigger.
Right.
The big growth stocks are leading the earnings growth path. So I'm just curious as to why it's such a crazy number next year without rate cuts.
So, and to be fair, just because I believe the indices are 15 to 20% too high, there will be winners. There will be protected when you talk about big tech, when you talk about things that are not as exposed to the consumer. The reason it's too high is that if I'm 20% below that, if I'm 5% below that, that's not a shock to the market. But if we have to see earnings revisions, downward revisions in the magnitude of 20, 15, maybe 25%, that typically has posed a very strong headwind to equities.
Well, but that also would suggest that you're pretty much in or at risk of a recession. And how does the Fed stay higher for longer in that context? Because, they can say what they want right now. When unemployment starts going up or they see these disinflationary forces in corporate earnings and the economy, they're not going to hang here at 5.5%.
I think the Fed is braced for that, Mike. I don't think the rest of us are, but I think that the Fed is braced for that, and I think they've told us that. When they tell us that they need unemployment of 4.4% to get to their target rate, that means that there needs to be 2 million jobs lost. So I think the Fed has tried to prepare us for that. We're not prepared for that, but they are.